Today, we're going to open up a company's most personal financial story. Think of it as a diary, but one written with dollars and cents, not words. We are talking about retained earnings. And trust me, by the end of this, you'll see it's one of the most powerful storytellers in the entire world of finance. Okay, let's get into it.
I mean, it's a fair question, right? A company just has a fantastic year, they're sitting on huge profits. So why on earth wouldn't they just hand all that cash over to the owners, the shareholders? It seems like the obvious thing to do, but the decision not to do that, well, that's where the real strategy begins. And the answer to that multi-billion-dollar question? It's hidden right here. It's not in some flashy press release or slick presentation. Nope. It's in a quiet little line item on the balance sheet that acts as a running log of every single strategic choice the company has ever made about its own money. All right, let's get one thing straight right from the start. This is not about a company hoarding cash under a mattress. Not at all. It's about taking the profits from this year's harvest and replanting those seeds to grow an even bigger, stronger company for the future. To really get this, you have to understand the two ways a company gets its money. First, you've got contributed capital. Think of that as the seed money from outsiders, investors who buy stock. But then you have earned capital. And this is the heart of our story. This is the money the company made all by itself. It's the purest sign of whether the business is actually working. So, what are retained earnings? Simply put, it's the grand total of all the net profits a company has decided to keep and reinvest since the day it was founded. Every year, a company makes a profit. It decides how much of that to give to shareholders as a dividend, and whatever is left over gets added to this running tally. It's like the company's own internal investment account, built up over its entire life. So how does this diary actually get written, chapter by chapter? Well, it's a really simple, elegant process of addition and subtraction that perfectly reflects the company's performance and its priorities. It all comes down to this really straightforward formula. You start with whatever the retained earnings balance was at the beginning of the year. Then you add all the net income you made this year, that's the big infusion of new profits. And finally, you subtract whatever you paid out to shareholders in dividends. And what's left? That's your new ending balance. It's simple, but man, is it revealing. Okay, we've arrived at the single biggest misunderstanding about this topic. Seriously, if you get this next point, you'll be ahead of 90% of investors out there. Let this sink in for a second. Retained earnings is not a pile of cash. It is not a bank account. A company with $10 billion in retained earnings does not have a $10 billion checking account just sitting there. It's an accounting number, a historical record of reinvestment. That's it. So you're probably asking, okay, if it's not cash, where did it go? And this slide shows you exactly where. That money was put to work. It was transformed into real things that helped the business make more money. It became new factories, it funded the R&D for the next big product, it bought more inventory to sell, or it was used to pay down debt, making the company stronger. The earnings were converted from cash into engines of future growth. This quote from the source material just says it perfectly. It's a historical ledger. Every single dollar in that retained earnings account represents a specific decision by management to choose long-term growth over a short-term payout. So once you know how to read this financial diary, you can start to decode a company's real strategy, how confident it feels about the future, and even what stage of life it's in. What's so cool is how different industries tell completely different stories. You look at a tech company and it's going to have a super high retention strategy because it needs every penny to fund the next breakthrough in AI. A biotech firm, it might keep everything, sometimes even running at a loss, an accumulated deficit, as it pours cash into finding a cure. But a stable company, like one that makes soda, there's only so many new factories it can build, so it has a low retention rate and pays out big dividends to its shareholders. The diary always matches the story. And this all leads us to this really important metric called the Sustainable Growth Rate, or SGR. What this tells you is the absolute maximum speed a company can grow using only its own money. No new loans, no new stock. It's a pure measure of how powerful its internal growth engine is. And this chart just lays it all out, doesn't it? A tech company that keeps almost all of its earnings has a super high SGR. It's built for speed. On the other hand, a utility company that pays out most of its earnings has a low SGR. It's built for steady, stable returns. The decision to retain earnings directly fuels a company's ability to grow on its own terms. All right, let's bring this all home. Let's see how reading this financial diary can literally give you a peek into a company's future. So I want to show you a number, just this one number, $5.42. What do you think that represents? It's not a stock price. It's a measure of pure, unadulterated value creation. This is the result of Apple's genius. For every single dollar of profit that they chose to keep and reinvest back into the company, they generated over $5 in new market value for their shareholders. That is the ultimate proof that a company knows what it's doing, turning $1 of saved profit into many, many more dollars of actual wealth. And that's really the big takeaway here. Once you get this, you're not just looking at surface numbers like revenue anymore. You now have financial X-ray vision. You can see right through the skin of the financial statements and look at the skeleton, the history of decisions that gives a company its real strength and shape.
So the next time you look at a company, don't just ask how much money it made. Ask yourself, what did it do with the money it made? Go look up its retained earnings. Open up its financial diary. What story is it telling you about its past, its present, and where it's planning to go in the future?